Welcome to Chit Chat Money. This is our Thursday deep dive episode where we interview an analyst, portfolio manager, or another investor to discuss a single stock, industry, or even, I guess, a broad topic. And today we have on the show George Levatis. He is the portfolio manager at Upslope Capital. And this is kind of a unique episode because we typically try to look at an individual business, but with George, we recently came across his presentation on short selling, and we thought it was a good kind of short selling 101 for people that aren't that familiar with the process. And so we asked George a bunch of questions about all things short selling, how to target different shorts, what to look for, what kind of red flags to try to identify in potential short positions. And then we also talk about his long book. It's a long short fund. So we also look at kind of what he's trying to identify for potential long positions and what his holding periods are, and really just general strategy for running an overall long short fund and some of the personal challenges or personal advice that he would give to potential fund operators or fund managers. So this was a fun one, I guess. Nothing else to add here. So without further ado, here's our interview with George Levatis.
Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schafer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Ryan and Brett are also general partners at Arch Capital, and Arch Capital may have positions in the securities discussed in this podcast. Anything discussed on Chit Chat Money by Ryan or Brett or any other podcast guests is not formal advice or recommendation. Now please enjoy this episode.
Welcome in. Today we are joined by first-time guest George Levatis, portfolio manager at Upslope Capital. We spoke, if you're a regular listener, we spoke a little bit about a presentation he created, I think in June, and we spoke about it last week on the Power Hour around short selling and some of the misconceptions. And so George reached out and he was gracious enough to give us some of his time to talk about both his career and then that short selling segment we want to touch on as well. So not our typical interview, not any specific deep dive on an individual company, but we're going to get to, I think, some unique topics that we don't usually talk that much about here. But let's start with you, George. First of all, welcome to the show and kind of give us some backgrounds. Give us some backgrounds on your career. How'd you get into investing? How did you end up deciding to start Upslope Capital?
Yeah, so thank you guys for having me. My career, I sort of divided into pretty standard in some ways. First half was more investment banking oriented. Second half is investing. I'd say I really was a bit of a late bloomer to investing in the buy side. I wasn't somebody reading, Buffett letters when I was 12 years old or something like that. If I could point to sort of one moment that really got me hooked, it was frankly the financial crisis. I happened to be in business school, right smack in the middle of the financial crisis, and I just remember being glued to my screen. No idea what I was actually doing with my own account, but kind of doing my best to try to navigate it and protect the money that I had and try to make a little. And so I think that was a key moment for me that it sort of clicked for me that it was something that I really wanted to do long term. And I think it also hammered home that I wasn't going to be a long only investor. I like to have all the other tools available. So I'd say that sort of got it in my head. It took me some time even after that to acknowledge to myself that that's what I really wanted to do. So kind of coming out of business school, I hit out in investment banking for a few more years, and then moved over to research at Bank of Montreal, where I covered the packaging sector for a little bit. Before kind of pulling the Band-Aid and jumping to a buy-side role at a startup long-short fund. So.
All right. And how did you start Upslope? How long has that been around? And maybe give any sort of, what's your guys' basic philosophy over there?
Yeah. So I worked for, as I mentioned, I worked for a startup long-short fund. I only did that for about a year. Was kind of itching to do my own thing. I have my own investment philosophy, and I think given that I was a late bloomer, I was kind of eager to get going with it. And so after about a year at that fund, I asked them if I could sort of start my own strategy, raise some friends and family money. And so that was in 2016. And then I sort of formally spun out and formed Upslope in 2017. The strategy is really a classic long short equity hedge fund strategy, fairly concentrated long book, usually kind of 10 plus names. And then shorts, I'm sure we'll get into it a lot, but shorts are a lot more diversified, usually 20 to 30 or more at times. Have generally a mid-cap focus, pretty global. So, I'd say longs are majority US, but do a fair amount in Western and Northern Europe as well.
All right. Yeah. And it does lead into what we're going to talk about today, which is short selling. But I would say, and maybe I'd guess about 90% of the listeners, maybe more, don't actually understand how short selling works. I don't think Ryan and I maybe understand a little bit, but we definitely don't understand it fully either. Can you explain, before we get into kind of the details of your presentation, can you explain the basics of shorting? How does it work for you guys when you're, say, going into a example position here?
Yeah, I mean, so I think when I think of short selling, I think, first of all, I sort of divide it into two broad categories that I think most people may be confused sometimes. So I think there's a big difference between hedging, so shorting indexes, shorting SPY or a major index, versus shorting individual stocks. The former I think of is really kind of a form of insurance where sometimes it pays off, sometimes it doesn't. In general, markets go up over time and you're going to lose money doing that. And maybe that's okay because, like I said, it's an insurance policy. Individual shorts, so betting against individual companies, betting on them doing poorly or derating or, going down effectively. That's the goal there is to make money. It's not just a, insurance policy that you expect will lose you money over time. In reality, obviously it's really hard to, you're fighting a rising market over the long run. So it's a tough game, but that's the goal of individual shorts, where you're picking companies that you either believe, fundamentals are deteriorating. You think it's we'll go into all these, I'm sure, but fads and frauds, things like that, where something you think is going to break with the stock or that will cause the stock to go down in some form.
Okay. Or go ahead. Yeah. Yeah.
And I guess just in terms of how it fits in, with the long short strategy. I think of it as a way so you can reduce market risk. So in theory, depends on the strategy, but in theory, you could use shorts to sort of enable you to get longer. So you can have more longs on at a time than you might be comfortable otherwise. I don't personally go, so, I think some funds are levered long against some shorts. That's not my strategy, but in theory you could do it. And I think in general, it's a good kind of blunt mechanism for managing volatility and market risk. So. Okay.
And I think some listeners are aware of this, but I just want to catch up any of the beginners here. What is mechanically happening when you're saying, I want to short this thing? How are you, you're probably going to the broker. What is literally happening? What is exchanging hands? Why are you getting the cash in? What security are you getting? What are they, all that stuff. Cause I think people are it's a little bit backwards, but at its core, it's not truly that hard.
People are probably imagining buying put options, I think is probably what a lot of people guess. So maybe the actual mechanics.
Yeah, I don't know. I'll probably do a poor job of explaining the behind the scenes stuff at the brokers for actual, what happens with a short. But effectively, you're borrowing shares, and promising to buy them back at a later date. Ideally, you get to decide when that later date is. Sometimes the broker, you can lose your borrow that you have on a short. That happens pretty rarely. But it happens with really, really heavily shorted stocks where there's no borrow available anymore all of a sudden. So in my experience, it's probably only happened a handful of times. And it's usually not a total shock when it does happen. But so in general, I think maybe one way to lay it out in layman's terms. So when you short a stock, when you pull up your account on Interactive Brokers or wherever, you'll literally see, minus 200 shares, next to the position, or however many shares you're short. And then you'll receive the cash proceeds in your account as well. So you've effectively sold that stock, even though you never owned it in the first place, but you have the negative share count as sort of a liability that you'll have to buy back at some point. I don't know if that actually explains it, but there's a lot more to it that I'm sure I'm either not explaining well or that I don't even understand, frankly, all of the nitty gritty details, but at a high level, that's kind of how it works.
Yeah, it to me, and it's sort of like when people explain the Federal Reserve, I think you can explain it, but for some people, I think almost everyone you need to explain multiple times before you actually understand it. But I want to talk about a fun question here, and maybe we could probably do a whole podcast on this. But what are some of the misconceptions out there about shorting stocks that you've seen? Chit Chat Money is brought to you by Interactive Brokers. Designed for active traders and sophisticated investors, Interactive Brokers offers trading assets in 150 markets with 27 different currencies. They charge USD margin loan rates from 5.83% to 6.83%, rated the lowest among margin fees. The ability to trade stocks, bonds, options, futures, commodities, and more with high interest rates paid on instantly available cash balances, plus the ability to lend your eligible stock shares to earn passive income, all on one single unified platform. That is why we at Chit Chat Money use IBKR and wouldn't use anything else. Restrictions apply. For more information, visit ibkr.com/info, member SIPC. Open an account with IBKR today.
Yeah. So I think there are a lot of them, certainly. I wrote some notes down on this in advance. So I think probably one of the biggest ones is I think people that don't short tend to assume that you only short a stock if you think it's going to zero. And that's clearly not the case. There's a pretty wide variety of shorts. The assumption that you only short frauds or fads, or that there's something nefarious with anything that's short, that you're shorting, that's not necessarily true. You can short perfectly great businesses. It's not necessarily a great idea, but you can do it. Valuation, being a primary driver of shorts. I think people kind of understand that that's generally a bad idea, but that's not how most short sellers approach it. I think time horizon is probably a big difference, or a big thing that people don't understand. So I think in general, at least I view most shorts as kind of shorter term oriented and a little more trading oriented. So I see a common thing I see is somebody pulling up an old, like a 2 or 3 year old short pitch, and sort of giving somebody a gotcha that they got it wrong. And I think most of the time that's not necessarily what the short seller is going for. They might have a 6-month time horizon or 3-month time horizon, and there's some event that they're looking for. And maybe they got it right, maybe they didn't, but usually I don't think they necessarily have the same time horizon that longs do. And then what else? I think those are kind of the main ones. Moral, you see a lot of moral crusades, and I think some short sellers have that as their approach, but I think most don't, and most realize that having sort of a moral element is if anything, probably a bad idea for a short seller.
Yeah, and ladder attacks, they're not real, right?
No, they're frowned upon.
Yeah, no, George is winking at us. No, but seriously.
So you, in your presentation, you lay out kind of how you what your strategy is for targeting shorts. Can you
Yep.
maybe explain what that is for anyone who hasn't seen the presentation? And then
Sure.
has this changed over time, or did you kind of always have this strategy since starting Upslope?
Yeah. So I'd say my approach to shorts has changed a bit over time. Really, the SPAC bubble was the biggest driver of that change. So in the before times, before the SPAC bubble, my shorts tended to be, 9 out of 10 of them were pretty boring companies. So they were cyclicals that were, I thought were going to roll over, or melting ice cubes. So like the classic, like I was short Franklin Resources, Franklin Templeton, for years, and Owens, Illinois, a glass bottle company. Like those were the typical shorts that I tended to focus on, where they just kind of ground down over time and they'd underperform the market, and, occasionally have little blowups here and there. And so I tended to focus on those. They'd be sized smaller than my longs, but they'd still be kind of chunkier positions. So, maybe 2, 3, 4% positions. And then I did a few fads and frauds, but they were really the exception. And, so I generally found them to be too much of a headache, and, I just didn't enjoy the process. Then the SPAC bubble came along, and it was just this fire hose of ideas. It was just, and I'm a one-man band, so part of it was the practical reality of trying to come up with a strategy for dealing with all these obvious opportunities, and not getting blown up in some form. So I've observed others and other successful short sellers, and came up with an approach to deal with the sort of fads and frauds and SPACs, where it was much more of a basket approach, and much smaller position size, and kind of go through a checklist of things that I was looking for fads and fraud, and say, okay, this company meets these, checks off these 5 boxes. I'm good to put on a 50 basis point short position in the company. I don't need to, I don't need to know everything there ever is to know about the electric vehicle industry or something like that. I know this is a fraud in some form, so no need to overcomplicate it. So I sort of honed that element of the short strategy, and it wasn't necessarily a wholesale change to only focusing on those. But, as sort of a subset of my shorts, developed this strategy. And I think that, that bucket has kind of come and gone over time. So I think, at its peak, I probably had, a 15% short position in SPACs total. So it might be, 30 different SPACs totaling up to 15% or something along those lines. And then, nowadays it's closer to like 5 or 6%. And so it's sort of pulled back a little bit. But I still do the traditional melting ice cubes and cyclicals, still short some sort of more quality type stocks, where I think people view it as a compounder, but it's, in my opinion, it's not. So still have sort of all those different buckets.
Yeah, I do want to talk about, I think you're referencing maybe a flip, as you coined it, which I want to talk about later. Okay, yeah. So that's a different one, but I want to talk about that because I think that was quite interesting. But in your presentation, which we will link in the show notes for anyone interested, and you can either DM us or email us and we'll share it. But you have this this chart that I might share the screen with, but it's pretty easy to describe. You just have the y-axis as odds of being profitable, and then the bottom axis is mental health cost, right? And you have fads and frauds both kind of in the upper right. So the odds of being profitable are super high, or maybe the highest, but they're very stressful. So can you talk about why they're so profitable, but also stressful at the same time?
Yeah. So I think they tend to be more profitable because you can figure out the ultimate endpoint for where the stock is going to go with a pretty high degree of confidence. So the easiest example, and they're definitely not, and I guess this wasn't easy, and they're definitely not all this sort of perfect, but Tattooed Chef was sort of prototypical example here, where I think, you could research a company and you could be very confident that it was eventually going to be a zero, because it was, the story didn't make sense. The financial model didn't make sense. It was a fad that, benefited from the pandemic and sort of a point in time bubble in the market. And at one point, valuation got, I forget what its peak valuation was, but it was chunky for something that was probably going to be a zero. And so you could be very confident that you knew where that was going to go. Now the mental health cost element and the stress of managing a position like that, you're obvious. If it's that obvious, you're not going to be the only one that sees it. So short interest is going to be high. Management is going to be, tempted to sort of promote and push the stock as much as possible. I remember being short Tattooed Chef kind of in the early days. And I think it, had one of many short squeezes where it was up kind of 10 to 20% in the middle of the day on no news that I could find. And eventually I remember it happened one time where the stock spiked, something like 20%. And I did a little digging and I found out that this penny stock newsletter guy who used to be on Fox Business had been charged. I think he'd been barred by FINRA at this point. But he had just put out a newsletter promoting Tattooed Chef. So stuff like that happens. It's you can sort of laugh at it because it's not real and it's going to give it back at some point and the end result, but you also have to manage your risk and you have to be realistic about how much you can handle, how much pain you can handle in the short term. So that's where sizing I think comes in and position management. But right. There's a lot, you're fighting a lot of stuff, even if you do know what the actual end result is.
Okay. And you mentioned Tattooed Chef, but you don't have to give the specific examples there. But what are some characteristics? Maybe we'll hit fads first, because I know they can be slightly different. And sometimes maybe the best opportunity, you can correct me if I'm wrong, is when it's both a fad and a fraud. But what are some characteristics of a fad that you're looking for, generally?
Yeah. I think of it as kind of know it when you see it, which is probably not a very satisfying answer, but like Tattooed Chef was, I'm guessing most people are actually not familiar with the company and their products, but it was a vegetarian, like frozen foods company, sort of a trendy frozen foods company. And they benefited from the pandemic, from kind of launching right around then. And people were staying at home and eating more frozen meals at home. And they played on to this. They sort of, even though they had there's nothing proprietary to what they were doing, they were just coming up with vegetarian meals. They sort of glommed on to the Beyond Meat and like the fake meat trend. Even though they, like I said, there was nothing that they were doing that was proprietary or unique about it. So I think, to me, that was an obvious sort of fad that they were glomming onto. And I think you mentioned, ideally in some ways you have fads and frauds combined. And in my mind, I sort of meshed the two of them together because that, especially with the SPAC boom, I think there are so many SPACs that combine both of those things. So like, so many of the EV SPACs, the electric vehicle SPACs, I think hit both of those categories. Yeah, I think sometimes fad is maybe too strong of a word that I use, but like I said, you still kind of know it when you see it.
On the fraud side, what are some of the signals you're looking for? I'm sure a lot of people, when they hear like fraud, they think Enron or something that's like massive, whereas maybe there's probably some more simple red flags to identify. What are some of those that you were looking for? Yeah.
So I'd say for me, I'm not as, I'd say I'm probably not as hardcore of like a fraud hunter as some short sellers are. It's kind of a lighter version of fraud, if you will, that I'm looking for. So I think like shady promoters. So like I said, this guy who'd been barred by FINRA promoting Tattooed Chef, like that's a sign to me that there's something probably wrong with Tattooed Chef itself. If this guy is glommed onto it, I mean, in theory, he could do it all on his own, but it's a sign. So I think aggressive promotion. I mean, there are some obviously, general accounting red flags. So changing auditors, stuff like that, that people know about. Before the SPAC boom, I was short a company called Eros International, which was back then it was known as the quote unquote Netflix of India. And I don't know that fraud was ever proven, but I think it was a pretty, people suspected fraud. And one of the big red flags there was they just had this ballooning receivables balance. So they always showed really impressive revenue growth. And then at the same time, though, the cash never actually showed up. So receivables kept going up and up and up. And then they'd get called out on it. On earnings calls, analysts would push back and say, hey, what's with the receivable growth? And they'd say, oh, no, we'll get it under control. And then the next earnings call, revenue growth would suddenly stop. Receivables would get a little bit under control. And so you could see the push and pull where they could either deliver revenue growth or manage receivables, but not both at the same time. So to me, that's sort of an obvious sign that something is not right. But I don't know. I think those are, say, promoters and some of the red flags I kind of listed on that slide. Let's see, I can mention a few of them.
Right. You did have, I think it was maybe 2 dozen. Yeah, something like that. Yeah. When management teams on the call talk about controlling the accounting, I think that might have been a red flag as well, right? Because they're like, well, shouldn't that just be, taking care of itself? But whatever. Yeah,
I think just to highlight a few of them. I mean, I think so. Going after shorts, I think any management team that. So one of the things I find interesting is, when you see an activist short report come out. Just watching the reaction of the company, if they actually go out and sue somebody, that's usually a pretty good sign that something's wrong. I think there's pretty good research that those stocks tend to underperform.
What do you think is a good reaction to a short report? Like, what should management do if they see it? Just not care?
I think in general, just not care. I mean, I think it's just sort of thinking out loud. In theory, if you had a short report come out and the stock went down, a lot, 10%, 20%, acknowledging it might be okay. But I think, I sort of grimace, at least if I owned a stock when that, if I was long a stock and a short report came out and that happened and management put out a statement and, snide remarks about short sellers, being, evil or standing to profit from this or, any kind of threats whatsoever to me is a red flag, but just sort of acknowledging it is maybe okay. Saying, we believe in the business and that's it. I mean, I think in general, they just shouldn't care too much. So.
That makes sense.
Yeah.
What?
All right, wait, let's get through any other important, red flags that you see.
So I think related party stuff, I think is always a big red flag.
Any examples that come to mind there? If you don't want to call them out, you don't feel like you need to.
I mean, one interesting one, and frankly, it hasn't worked out as the way I thought it would over time. Is this company Coke Consolidated, one of the Coke bottlers? They have an interesting one where are you either of you familiar with this story?
No.
So it's a Coke bottler in the southeast of the U.S. It's a really strange company, and their CEO. So in their actual 10K, I'm forgetting the exact line, but their company says, I think their company motto or something is along the lines of, our purpose is to honor God. And their CEO is clearly a very religious character. Nothing wrong with that. However, if you go through their proxy, you see that he leases, he owns a bunch of the buildings and uses a corporate jet and sort of pays himself very generously for considering this as a relatively small, it's kind of a mid-cap company. So just I always thought that was an interesting, very quirky company, where the related party stuff doesn't really jibe with kind of the messaging of the CEO. So like I said, we'll see how that one turns out someday, though.
It is, I think, yeah, like you said, there's nothing wrong with being a leader at a company and being religious, but commingling the two feels like you're doing it to promote the business to other people that are religious. So I think that's one we've seen too, where it's like it kind of feels like when you're doing it for the greater good, or you start to invoke that, it starts to feel like a red flag.
Yeah, especially when I think some of the, like I said, the related party actions are not consistent with the greater good, at least from the outside. That's what it looks like.
Makes sense. Any others? Not examples, but any other red flags?
So it probably seems like a throwaway one, but little obvious lies. I always, that's something that I pay a lot of attention to. I think people roll their eyes sometimes when I point things out. But I remember one CEO going on Mad Money a few years ago, and he had been buying stock, and he is a very promotional, I won't name names, or I'll try not to. He's a very promotional guy. And he had been talking about, Kramer asked him about, how, I see you've been buying shares recently. This is a good sign. And the CEO, you could watch it and see he was just lying through his teeth. But he said, I really wanted to buy more. I had my buy order in, that day, but it just barely missed my price before the close. And now it's like the blackout window now, so I can't buy more. But just stuff like that, because I think, it's sort of the cockroach theory where, you see the little obvious lies, there's more behind it. And so I pay attention to stuff like that.
Now, is this another good example, which I guess this one has been sort of revolved because the entire management team is gone now, but back in, I believe it was 2018, 2019, the Peloton CEO and founder went on CNBC and said it was either we're surprisingly profitable or we're incredibly profitable, something along those lines. And then the S1 came out and they went public, and you could see that they're hemorrhaging money. Is that a clear example of okay, that would be a big red flag for you? That's a company I might want to look at.
Yeah, I didn't look at it, but yes, it would be.
Okay. All right.
What are some of the most memorable short positions that you've had where it was either for good reasons or bad reasons, like something that ended up going totally against you, or something that was like the most chaotic, or what's the term you use? Most detrimental to your mental health?
There's a long list of those. Eros, the Netflix of India, that one, I mean, that was early on in my in Upslope's existence. That was memorable just because of everything about it was kind of hard to believe, just how obvious I won't use the F word, but how obvious the sort of scamminess of management was. And, like I said, there's this push and pull between revenue growth and receivables, and they would frequently miss. So they would say, first of all, they wouldn't tell you when they were going to report earnings. And then they'd say, okay, fine, we'll report earnings, really late in the quarter, and they'd give you like 24 hours notice of when the earnings call would be. And then the earnings call would come and they still wouldn't have put out their press release for earnings because, I mean, it was, they'd put it out half an hour into the earnings call. So it was just that was really, one of my earlier exposures to kind of blatant manipulation or promotion or whatever you want to call it. I don't know. I'm always afraid to use the F word, but and I think, probably related to that, Eros actually sued a bunch of folks on Twitter. So they, it was a pretty contested stock. It was a pretty well-known short thesis. And I forget how many people they roped into this lawsuit, but they actually sued, I want to say it was almost a dozen anonymous Twitter people, which became not anonymous through the lawsuit. So I remember, when the lawsuit came out, being worried that, making sure that I hadn't said too much about Eros and that I wasn't going to get roped into some lawsuit that I, had nothing to do with. And, it was an interesting case study, I guess.
Have you found it easier, or do you prefer to just be kind of quiet about active shorts?
It kind of depends, I think. I think for the ones that are working, I'd rather not mention them. Sometimes there's a narrative that I see out there that I don't know, it just kind of offends me in some way, and it's really hard to resist not kind of poking it a little bit. But I think in general, that's probably where I've wound up is, I'd kind of rather keep it a little more quiet. But like I said, sometimes I think the narrative is just too ridiculous to resist.
That's understandable. Okay, so I think we've touched on maybe some of the characteristics in trying to identify prospective shorts, but like you said, it's competitive. There's a lot of people out there that can identify these. Yeah. How do you think about the portfolio management side of things? You mentioned that you've become a little more diversified over time. Just any thoughts on managing a long short book overall? Yeah.
So like I said, I think I've become more diversified probably just through the addition of this kind of fraud and fad. I called it the SPAC plus short basket. So I've got sort of my regular way shorts, any cyclicals, anything that I think is going to break fundamentally in some form. And then I've got sort of the frauds and fads and SPACs on the other hand. And so really it's just kind of making room for those and keeping an eye on aggregate exposure for those fraud and fad shorts, making sure that, aggregate exposure doesn't get too big, keeping positions, individual positions right sized. So I think there's always a delicate balance between, where you're kind of, I'd say more passively short frauds and fads where you don't know when necessarily something's going to break, eventually it will. And for those, I try to keep position sizes really small so they can be 25 to 70 basis points or so is kind of typical. And then once things really start to break, so like Tattooed Chef in the end, you can kind of push it a little bit more, maybe 150 basis points if you get really, really adventurous. But like I said, I think you need to manage around events. And one thing that's, I think, both frustrating and an opportunity for these type of shorts is because they're susceptible to squeezes and promotion. They do move around for non-fundamental reasons a lot. So I think the goal should generally be you want to be in a position where you can add to the short when that happens. So if you wake up tomorrow and this, whatever your short goes up 20% on zero news, ideally you're already small enough that you can add to that position. And then, maybe when it pulls back, you ease off a little bit. But it's really kind of managing around stuff like that.
Do you think you'll ever see, I guess, as much of a maybe gold mine might be the right term, as what you saw during the SPAC bubble for trying to identify shorts?
I think so. I mean, if you had asked me, I wasn't investing during the first tech bubble in '99, but if you had asked me in 2019, would we see that again? I probably would have said no. And I'm guessing these things kind of, they just happen, and it's impossible to know when. Maybe the next one will be 15 years from now or something, but I'm sure at some point something wild will happen again.
Is the opportunity, are you still seeing the opportunity there today, like in some of these SPACs, or has it, for the most part, are you reverting kind of back to what you were, the way you were shorting prior to COVID?
Yeah, I've reverted a fair amount back. So I think today, like I said, I think I'm probably 5 or 6% is sort of the aggregate size of that type of short for me now. As they get smaller, the actual market caps and enterprise values shrinking, you kind of want to shrink a little bit with them. So it gets tougher, I think, over time.
Right. Now, one interesting thing I saw in your presentation was what you call a flip. And I don't know, well, you can correct me if it seems like it's uncommon in short selling, but maybe it is common. So what exactly is that?
Too. Yeah.
Okay.
So it's really, so it's hard. I'd say hard psychologically, but the idea is, if you're long a stock and you have, as you should, you have a clear thesis and something happens that causes your thesis to break. And it's a really obvious, it's just, okay, I'm just going to cross off these, 2 out of 3 of my thesis points and we're done. So the thesis is broken enough that that you should exit, promptly. If you're in that position, you should, if you also short, you should consider flipping short and not just selling and exiting your long, but actually flipping short. And I guess my idea here is that if you have such a clean thesis break, there will be other people that have, that have that are in a similar position, and they're not going to move. Most people tend not to move that quickly because they're institutional constraints to exiting. You're not just going to exit in one shot. And so usually I think it represents an opportunity to get short and actually make some money out of a bad situation. The example I had, so it's rare for me. I think I've done it maybe three or 4 times. The sort of classic example for me was I was long a company called Crown Holdings. They make, beer and soda cans mostly. And I had even pitched this. So Crown was one of my biggest long positions. I think it was my first time at the ValueX Vail conference, which is where I made this short pitch. So I think it was my first time there. I pitched Crown as a long idea. And about 6 months later, they announced this horrible acquisition. So Crown historically, the pitch was basically that Crown was this ultra defensive company. They make beverage cans and food cans at the time. And they came out, I think it was like right before Christmas, and said, we're going to buy a transit packaging company. And they completely blew up the long thesis because they made, part of the company was now cyclical, whereas before it was not cyclical at all. They were no longer going to be returning capital and, accelerating a buyback program. They were going to be levering up and buying this cyclical thing. And then there was also no strategic rationale for the deal. It was just that they kind of liked the asset. So I that was one where I flipped from long to short. Felt really stupid for, I think, about a week or 2, maybe even longer than that. But eventually I think it worked. Doesn't always work great, but that was sort of what got me thinking about this framework of, okay, if you have a very clear thesis break, you should consider actually shorting it.
Did you come back to the conference and pitch it as a short?
No.
Okay, so talking about the long book, when I was looking at your shareholder letter, I was gonna pick out a couple companies and try to ask some specific questions, but aside from one, I really did not know any of the companies whatsoever. And so it looks like a pretty unique set of businesses. Is there any common characteristics that you're looking for in these businesses? And then maybe what's your typical holding period? Are you trying to hold forever? Is it like a never sell approach, or is it you kind of have a price target in mind?
Yeah. So I'd say my style is I'd say my personality more than anything is I gravitate towards pretty defensive, growing but boring businesses. So not like, for me, a growth company is like high single digit organic growth. That's like a exciting growth stock for me. So non-cyclical, good balance sheet, easy to understand. So like I covered the packaging sector when I was on the sell side. And so sectors like that and companies like that, where it's a simple product. I get the model, like I can figure out where they are in the cycle and expectations. I'd say I want to see either at least sort of a neutral secular trend. So it doesn't have to be some amazing, growth tailwind, but I don't want it to be a melting ice cube that I'm trying to get cute with. So I do try to fight my tendencies to only buy boring defensive businesses, because it's a tough way I'd say to make money over time if you only do that. So I try to force myself out and look at more value, but more I'd say more cyclical stuff that might have a little more zip if I'm right. I break up the longs into two categories. So core longs are more compounder types. And holding period on those tends to be multi-year. So I think, of the core long positions today, I think average holding period is, at least, 2-3 years. Biggest position in the portfolio is a company called Aptar. And I've owned that almost since inception of the strategy. So almost 7 years. And then tactical positions are more what I describe as more traditional value stocks. So no one's going to mistake them for some world-beating compounder. They might have some hair, they might have some leverage. They're definitely, more cyclical. And for those, I'm a little more price sensitive. I have a price target in mind. And when the stock approaches that price target, I'm starting to leave. And so, ideally for those, I think holding period is like, 6 months to 2 years. There's definitely more turnover in that category where, if something doesn't look right and it's not working out, I'll cut it and move on. Whereas with the core positions, I'm a lot more patient.
Right. And now, where's your idea generation on the long side? Is it the traditional way? Is anything unique? Because I know the shorting stuff is kind of looking for the promotional CEO, stuff like that. But the long side, what's your research process? Where do you start? Yeah, so I lean a lot on my sort of prior background. So when I was a banker, I covered the exchanges and brokers sector. So do a lot in that sector. I do a lot in the packaging sector, which is what I covered when I was in research. And I mean, it's funny, they're two completely unrelated sectors, but I found them to be really good, especially packaging, I think is a great sector for long short investing, because it sort of hits my point on like easy to understand. It's a very finite universe. And on top of it, there's this great diversity among the companies within there. So there's, you have some really cyclical, really tough businesses. You've got some really good, steady businesses, and kind of a range of management quality. So I found in packaging that there's always something to do both long and short. And the exchange sector is one that I've always liked because it's more on the long side, but I love the business model of exchanges where they've sort of moved away from this a bit, but where they have leverage to volumes and volatility, and then sort of a secular trend over time of people,
investing more, and more individuals investing more and becoming more sophisticated. Things becoming more electronic and more profitable for the exchanges. So,
are there any? I guess maybe I should rephrase it. How do you get comfortable with some of the markets that you're investing in? So when I was looking through your long book, there was a lot of markets that I've never personally invested in. I'm trying to remember them right now. I know that I saw Switzerland.
Yep.
Some others.
Norway.
Is there anything that, like, I don't know, what do you look for to get comfortable investing in those markets? Does it feel that different than investing in the US?
I guess not at this point. I'm trying to think if there was, I'm sure there was sort of a learning period where I got used to it. I mean, I think sometimes the disclosures are definitely a little slower, just in terms of, reporting can be less frequent, and that's something you just have to get used to. I think in general, like so part of, I mentioned my focus is on mid caps mostly. And I think to me, that's a little bit of it's clearly not perfect, but it's like a little bit of a check on governance. And it's like, if a company's made it to sort of the mid cap range, it's probably less likely to be super sketchy versus, like if I were buying a, $200 million stock on the London AIM exchange, like I'd be a lot more worried versus, a $5 billion Norwegian company. But like I said, it's not perfect, but it's just a little bit of a check on it.
Okay. Unless Brett has any more questions, I think we've got a last one for you here, which is, if someone listening today is thinking about starting their own fund, let's call it a long short fund, what advice would you give to them?
So a few things. So I think having your significant other, if you have one, having that person on board 100% is like priority number one. Number two is, I think, being aware that, so before I started my fund, I talked to a lot of people and sought advice from a lot of people who had done it before. And I realized there are sort of two different paths or two different types of advice I would get. Some people would say, don't do it. You have almost 0% chance of succeeding. You need to raise at least like $500 million to be successful, and on and on and on. And then other people who say, yeah, just like keep your costs low and, focus on what you're doing, and, gave sort of general advice, like, said it's tough, but if you really want to do it, go for it. And so I sort of realized that you've got these two different types of people that give you advice, and, the don't do it, you need to raise $500 million types. They're completely correct if your goal is to start a big asset management firm, and be completely institutionalized. But if your interest is in forming sort of a boutique, one or two man band asset manager, and you don't need to raise $500 million, and it looks and feels and smells very different from, the big asset manager thing. So I think just keeping that in mind, all of the advice is useful, but keeping that in mind that people have wildly different perspectives, I think is important. And then I think if you do go the boutique route, just, setting yourself up to succeed and to have as long a runway as possible to actually build a track record, I think is the best thing you can do. So the last thing you want is to have financial pressure while you're trying to develop a track record. So I think keeping your expenses low, you don't need to do anything too crazy in the early days, and no one's going to care, if you have, some really impressive vendors, if, right when you're starting out. So just making sure that you have the pressure kept off of you in those early days, I think is important.
Okay, I think that's all the questions we have. So I guess for any listeners that want to learn more about you, see more of your work, what are the best places to do that?
So my website, it's just upslopecapital.com, and also on Twitter, Upslope Capital.
Awesome. All right. Before we sign off, I want to throw a disclosure on this. Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Money is not formal advice or recommendation. We are, however, general partners at Arch Capital, so clients may have positions in the securities discussed in this podcast. Thank you all for tuning in. Thank you, George, for joining the show. And we'll see you all next time.